Welcome back to Trade with Conviction. I'm your host, Neil Crosby, and I'm sitting here with June Go and Jorge Molinero this morning. How are you guys?
Hi everyone,
Hello.
all good here?
Very good, thank you.
Good stuff, good stuff. Shall we get stuck in? It's currently 10 o'clock Geneva time on Thursday morning, and we are sitting on the news websites and Twitter looking at potential deal headlines. How do we feel about that? I think my base case is that we should not ignore it, but be highly skeptical about the success of these things. But just to caveat everything, because obviously this comes out maybe 2 or 3 hours later, we don't know of a firm deal yet, and maybe the Iranians get back to US proposals within the next couple of hours. We just don't really know. But just so that our listeners are aware, what happened the last few hours or the last few days, Donald Trump did have a kind of military mission to start to guide vessels through the strait. And then there was a U-turn, and Trump wanted to see whether a diplomatic solution could be reached. And then, of course, yesterday there was a big Axios headline, another Axios headline, that a one-pager deal was about to happen. And then that turned into a one-pager potential deal to restart talks, and blah, 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 blah. I mean, it's very, very hard. It's very, very hard to say much about it. I was noticing also on Twitter last night, there's more reports of, big short trades having been done 30 minutes before this headline. I don't want to comment on.
I mean, there's a lot of outrage about this, right? But what can the rest of us do? And the market is just stuck and trying to figure out where to trade based on all this potentially, I don't know how is the market going to react, right? It's whipsawing just based on this potential news, and it keeps changing.
Yeah, and it's just a complete merry-go-round, isn't it? We've definitely been here multiple times before, and I can't say much to the latest round. It is about dueling unpredictabilities, right? It seems like the crisis is gridlocked because the US shifts its policy erratically based on, some highly visible domestic pressures, right? One being gas prices. I mean, gas prices in the US are rising again. And then I think for most market participants, the Iran's red lines and acceptable concessions are still a bit of a mystery. I think includes me, and I think that includes the majority of the market as well. If we are just trading headlines, if I look at, let's leave Brent prices for now, but if I look at ICE gas oil spreads, the front spread, even though we're expiring soon, is plus 35 as we speak. It was plus 100 10 days ago. The M2-3 spread is plus 50. It all looks very cheap. Also considering how long it's going to take to get things moving again, even should a deal be reached tonight. Maybe that helps regarding price direction even for the next couple of days. And the thing is, the physical reality check's still ahead, right? If we look at the numbers last night from the US, it was a bit more, I was going to say disappointing. I wanted to see a bigger draw in a way because it fits my narrative. The fact is, week to week, you're going to get bigger draws and slightly less big draws. But on average in April, we're still drawing 1.4 million barrels per day of commercial crude and core products. So that's big. It's bigger on total crude and products, of course, because we got another 1 million barrels a day of SPR draw. And we have been starting to talk about when do inventories actually run dry. And if you just extrapolate down the recent rate of draws in the US, let's say, because those are the visible ones, diesel looks particularly interesting. So if you just extrapolate down US diesel inventories, it's a problem even in the next few weeks, end of May, maybe. Commercial crude is different because the SPR is softening things, so that the commercial crude curve isn't so desperate, although we do get more runs in the next month. So it's really only a few weeks away before particularly US pricing has to start to defend itself. And Jorge, you can talk about that in a minute on the gasoline side. The latest one over the last week or two has been the TAR, the RBOB-EBOB spread. And that is exceedingly strong, pretty strong for seasonal levels. But we'll get to that over the next 30 minutes. June, what about refineries? Any turnaround news?
I think in Asia, we have two key refineries that have planned maintenance. In Korea, SK Osan has a 260 kbd CDU, a 66 kbd RFCC, and a 30 kbd gasoline desulfurization unit expected to be down from 20th of May for about 40 days. Reliance 660 kbd CDU and a delayed coker is planned to be shut down for 4 weeks right after Nayara's refinery restarts in mid-May to minimize the impact on domestic Indian LPG supplies. FYI, the Reliance refinery that is coming down is serving the domestic market, so we should still expect diesel exports out of SICA. On this turnaround, I just want to highlight that all these schedules are typically prepared years ahead, and the exact timelines for doing the works are narrowed down months ahead because you have to have the crew and the equipment ready to do specialized jobs for the turnaround activities. Additionally, you also have to do a lot of refinery feedstock planning and inventory management for the product side. So in the current environment where product cracks are dictating refineries to run as hard as they can, shutting down seems to be very costly. But it's just not easy to postpone turnarounds because of all this resource planning. And you also introduce further risks to process safety incidents if you postpone the maintenance beyond the natural timeline of the units. So for those who are looking at product cracks and saying, no, we might still see refinery run rates being high, just caution that, you will still have all these turnarounds activity happening.
That's an interesting one on India as well, because aren't Indian domestic diesel prices somewhat more regulated than over here in Europe? I mean, I've definitely read a few headlines about the economics for Indian refiners, depending on which crudes we're talking about in the past, aren't that hot because they're unwilling to raise the diesel prices, particularly before the election.
Correct.
So that also probably affects the way people think about maintenance to a certain degree, if possible. And it's been spurring all this talk about, okay, how do we cool domestic Indian prices? Well, one of the ways is to limit exports, right? So we've had a turnaround in the way China's thinking about exports, but it's still possible down the line that India tries to cool its own domestic market via tax systems that are in place already.
Yep.
What about crude? Let's go to physical markets. June, what's happening on physical crude?
Okay, we had the Saudi OSPs release yesterday. It's $4 per barrel lower across the board for Asia, $2 per barrel lower for Europe, no change for the US. Market was expecting about up to $8 per barrel discount for Asia. So it does seem like the Saudi barrels looks expensive right now. Just remember as well, the previous month they did discount a lot more than what the market expected, so it's kind of averaging out the impact. But then from a buyer point of view, what are the spot crude alternatives to buy? You only have Murban and Oman that is coming out, that is not part of the Strait of Hormuz closure. We did hear a report that Upper Zakum moved at about OSP plus $20 per barrel ex Fujairah tanks. I'm thinking that why someone who is willing to pay up that much for the Upper Zakum crude, it could be due to quality issues. Because again, when we look at crude, it's not just about the sulfur and the API content. Qualities like nitrogen, total acid number, which is 10, and metals content plays an important factor as well for refinery configurations. Nitrogen, vanadium, and nickel, they affect catalyst activity. Pipeline metallurgy has to cater for a higher TAN. For example, carbon steel pipelines, they can corrode very quickly if you're exposed to a higher TAN crude. Middle East crudes, which is what most Asian refineries are designed for, generally have lower nitrogen, TAN, and metals content than LATAM, WAF, Canadian crude alternatives. Additionally, some of these Middle Eastern crudes have better quality for making base oil and bitumen. For example, Oman, which is available, has elevated TAN and poorer bitumen qualities compared to Upper Zakum. So therefore, you can see a quality premium attached.
Yeah, it's interesting, June, because obviously there's a couple of things to that. The first is obviously we had an attack on Fujairah this week. So it's concerning from that perspective that we might be short of these, let's say, volumes that might have moved. I think the expectations for the volume of Upper Zakum that could be moved this way were probably low, but it's definitely doesn't give shippers any confidence. And it's interesting that you say Arab Light looks cheap, but we're still willing, as you'd be saying, in contrast, we're willing to pay maybe $20 over OSP for Upper Zakum. So in a way, Arab Light is cheap.
Arab Light is expensive.
Well, it's expensive. Sorry, you said it was expensive, but in contrast, it's cheap when you look at what's happening on ex-Fujairah barrels. And the concern is there's been a lot more sort of pirate attacks off Somalia as well. So it's not a super easy route going forward as well. But it does explain also maybe why the Asians are not willing to bid up, for example, 40s or WAF by another $10 per barrel. This quality difference, right? And so it really seems like the quality of AG crude is irreplaceable to a certain extent, and also with, let's say, Brazilian or even sort of heavy LATAM stuff, because we're just not seeing the sustained bullishness on physical crude premiums. Like if you look at 40s just now, the premium yesterday is $1.80. And of course, we've had a big sell-off in Brent. That's an average 2024, 2025 level for 40s, even though Brent spreads are +5. So something is holding us back. And it seems like the quality is an underrated element of this whole story. What about SOMO?
On the flip side, we have SOMO, which is the Iraqi company, doing Basra Medium at FOB up to $33 per barrel discounts. But the catch is the buyers need to enter the Strait of Hormuz to load the cargo because it's on FOB basis.
Yeah, so that means probably 2 transits, right? So there's a couple of problems with that. There's 2 transits, and I presume it means a payment to the IRGC. So we heard there was a major trading house that might have been interested in some of these barrels. Do they have to pay the IRGC? We'll see.
But it's sanctioned, right? So it's not supposed to.
Exactly. Exactly. So I think the base case here is that it's, even if it does happen, it's still going to be a bit of a small flow, right? It's not going to be a big flood of Iraqi volumes coming back to market. I think that should be our base case just now.
Yeah. Okay. Then I'll just talk about Japan. They have bought record volumes of US crude for August delivery, 12 million barrels noted so far for both WTI and Mars. And just for contrast, pre-crisis levels, they were doing 1 to 5 million barrels per month of US crude. Yeah. So I think what's happening is, we are locking in these huge exports to Asia for June and July, whilst US stocks keeps drawing down and the short-term fixtures probably needs to drop away to compensate. For example, the impact to EFRAs to Europe.
Yeah, I agree. The whole story about we're locking in extreme US crude exports, we're locking in extreme US commercial crude draws, and the natural thing is that the Brent, the Afra arb into Northwest Europe needs to close, and that might be an interesting signal for Brent down the line. I've been saying that for a few weeks. I've been at least a month early and probably going to be 2 months early, so completely wrong on the timing, but I think the concept is still very valid.
Northwest Europe to Brent diffs. I think we talked about it already, where 40 swap is now at the 180 level. And we are hearing what SPRs, crudes going from the US to Europe as well. What, 10 to 12? Yeah.
Might be 10.
I didn't catch this point actually. Yeah.
10 or 12 Afras maybe is what I'm hearing of SPR crude. So additional supply. There might be Mexican going to Europe. So we've heard, for example, Vitol heard buying Mexican, Olmeca and Maya, some of which is going to Europe where they own some refining assets. So if you take that plus the general North Sea diffs and WAF diffs, it just seems like Europe has enough crude, which is just highly surprising in this whole environment. It just everything is taking much longer than we expected at the start. And I think that's natural. Like as an analyst, you go, it was already late February, right? Yeah, as an analyst, you go, look, we're missing 15 million barrels per day. And then it's just taking longer to fully, let's say, filter through to the entire physical market on crude. What about TMX?
I think I just want to do the Canadian TMX special today. The TMX pipeline has a nameplate capacity of 890 KBD. It runs from Edmonton, Alberta to Burnaby, British Columbia. The exports to Asia usually goes via Westridge Marine Terminal that has a nameplate loading capacity of 630 KBD. There is, however, a draft restriction on this terminal, limiting only 550 kb load out of the Aframax capacity for these exports. The 2 key grades that get exported out to Asia are Cold Lake and high 10 AWB. In reality, the TMX pipeline can actually move light crudes and also refined products. It's just that the economics are currently not compelling to do so. For current run utilization rates of TMX is looking very high, heading to Asia, particularly to China. Rongsheng or ZPC has been a key off-taker of TMX crudes. But since the onset of the crisis, we have seen India and Singapore also picking up a few Afras of Canadian oil. However, these crudes are high in 10, the total acid number. Lake is 1.32, the high 10 AWB is 1.86. Contrast this with Basra Medium, which has a 10 of 0.24. So you basically need to blend down the 10 to refinery limits based on the design Middle Eastern crude, say to like 0.3 levels. So if I work backwards, it's about 10 to 15% of blending, meaning for every 550 kb cargo of Canadian oil, you need close to 6 million barrels or 3 VLCC equivalent of the low 10 crudes to be blended off. So that shows you the challenge that we have in Asia to take more of these crudes, even though they are available.
Sounds like they need lots and lots more WTI.
Expensive options, yeah.
Thanks very much, June. Jorge, shall we go to light distillates? What's been happening?
Yeah, in the last podcast, we had a very good debate about TAR ban East-West mainly on gasoline. So I think we should do an update on this. So we talk about TAR being open, the physical art, sending an MR cargo from ARA into Part 1. It keeps open. It's more open than the previous week. And in the prompt, we are showing in the margin for a blender around 8 cents per gallon. And if we move into deliveries in July, we are starting to see, in June, we are starting to see the numbers also picking up. So it's already open for refiners, not yet for blenders, but we are seeing how this art keeps improving. That would be on the physical side. I think it makes sense since we are seeing stocks drawing in the US, not on a very low levels yet, but if this dynamic persists, we should see more cargoes going from ARA into Part 1. We come from 3 years where the levels have been low, and it has been hard to see the margin open even during summer. So it makes sense that this summer we will see higher TAR on paper than the previous year, and this margin open more frequently. Yeah, after this we've seen a small correction on the TAR paper. We talked about this last week, like, okay, right now the TAR paper is enough to open the art, but will we see a correction or it's something structural? I think we are seeing a small correction that can be a short term, but this summer could need higher TAR than the previous years to keep the art flowing from ARA into Part 1. So that's a very interesting point on gasoline, one of the main things we are looking at. And it has an impact on blending components that we felt almost immediately. So we've been talking for a while about components lagging in the uptrend of EBOB and RPOB. Right now, it's not that case anymore. We've seen a strong rebound in almost every component in the US and in Europe, led by refinery uptrend. So it looks all in all like the gasoline market is starting. Well, it started already when the ARB was open from ARA into Part 1, but it keeps strengthening, and we could see a strong summer on the gasoline side if everything remains like this. Then on the freight side, we talk about the other driver, apart from paper TAR that opened the ARB, was low TC2. Right now in our freight dashboard, the prediction that shows for TC2 is bullish, maybe because of this arbitrage being open, so there are more opportunities for this transatlantic route, so it could trade higher from now onwards. And then moving to the other side of Suez, we are seeing a small rebound in the East-West, but it's clearly a change in the trend. We show a very strong downtrend that started, if I'm not wrong, the 8th of April with the announcement of the ceasefire. So it has been 1 month in a row falling, and right now we are seeing some recovery. We've talked about the impact of this arbitrage. Some of them, Europe was the cheapest source of supplies in the beginning of the war, and then after the downtrend in the East-West, outlook started to change. So more and more outlets were pricing to Singapore. Yeah, I don't think we'll see the high values that we saw for East-West in the beginning, like 1 month and a half ago. This rebound could keep going a little bit. Still, almost every arbitrage in the east of Suez belong to Singapore. Just a couple places in East Africa belong to Fujairah. Yeah, so that would be anything, Neil? Any comments?
I was discussing with Miles also the ARB short term, and it does look very supportive for Europe still, right? So Europe it's got an open ARB to New York Harbor. That's essentially what the TAR has done. Plus, Europe is still capturing a lot of the LATAM destinations.
Yeah,
versus Houston.
Almost everywhere.
It feels like we had gasoline tightness in the US. There was a small panic about it, and now EBOB, or Europe, let's say, is in particularly a strong position. We're already starting to see components rally, as you said, on both sides. So maybe it is a case that very temporarily EBOB strengthens preferentially. But I see your argument about, generally speaking, we might need to move more volume TA over the summer.
Yeah. On the EVOP side, yeah, the outlook is, if you look at the arbitrage perspective, is also bullish. Summary of what we have seen was being a marginal barrel also in gasoline, helping to cover the lack of AG. And then as we move into summer, they focus on their own supply for the local market. ARA becomes cheaper into almost everywhere in the Atlantic Basin. I think from the arbitrage we track, deliveries in end of May, ARA is cheaper everywhere. And not just that, but the US market start to bring product from
Yeah. And it just feels there's one more thing that we often look at. It's the E5 and E10 blend margins in ARA, right? And those are wildly open. But from what I understand from Miles, that's something that you should largely ignore when ARA has lots of export options, right? Because it's actually easier to fix an export cargo, so to speak, and actually blending in the window E5 and stuff is actually small parcel sizes, a bit of a pain in the ass. And when ARA is in a strong position in the export markets, just ignore the E5 blend, essentially.
Yeah, it makes sense. Yeah. Right now, with all the options for a European blender abroad, they are not gonna oversupply the local market, right?
Yeah.
Okay, so we can move into naphtha. The picture is different than in gasoline. So we are seeing garbage paper market, weaker time spreads, weaker cracks in Europe and in Asia mainly. And also on the physical side, we keep seeing a correction. The premiums in Japan are still, and Korea are still very, very strong compared to the historical baseline, but they are well below the values that we have seen during the war, like 1 month ago. Yeah, first half of June deliveries, which is being negotiated now, looks weak in terms of arbitrage. Almost everything is close from Europe and the US. Some arbs could arise from the US Gulf Coast, and also some typical switching barrels or typical arbitrage barrels that go to the east, like Algeria, could keep going, but it's not going to be a massive pull from Asia like we saw in the beginning of the war. Yeah, the support could come from July onwards. So in the beginning, with the lack of AG barrels, that was like a race to bring all the product that you can, and in this case, naphtha, from the west. And then once you have kind of filled a little bit your inventories, then you enter in a wait and see mode. So I'm going to reduce my rates. I'm going to wait. I'm not going to pay the plus 300 per metric ton premium that was negotiated at some point. But this cannot last forever. If we keep seeing AG with very few cargoes of naphtha, the premiums will need to rise. The East-West will need to widen again to allow more cargoes going from ARA into Asia. And from Europe, mainly from Med and from US Gulf Coast. And the strength now have moved, linking this to gasoline, to the blending qualities. So C5 LPMs are more supported now, looking forward, because the margins for overall gasoline arbitrage blending are improving. So we could see the gap widening between the blending qualities and the paraffinic and petrochemical qualities. To end with a summary, these two ideas, a bullish gasoline more in the Atlantic Basin, but also East-West rebounding, and a weaker naphtha due to the arbitrage close to the east, is being translated into GASNAP, which is at the moment very strong. We talked in the last podcast about if the ceiling is in 2022 values. We still don't know, but there is still a big gap with the historical highs that we reached that year in summer.
Very good. Thanks very much, Jorge. I think I'll take us through the middle distillates quickly then before June finishes off with fuel oil. A very general comment. Front ice gas oil spread plus 36 when I looked 20 minutes ago. Just looked very cheap. I know we've had this big sell-off, but generally speaking, as I was saying earlier, that looks too cheap at this moment in time. The M2, M3 spread is plus 50, also very cheap. We've had this big sell-off, and yet at the same time, the East-West has also been extremely weak, which is possibly slightly counterintuitive, and I'm wondering why it's happened. We have talked a little bit last week about all the incremental good news in Asia, and that includes things like, okay, South Korea and Japan have probably covered a good amount of the crude they need for the next few weeks. China's been softening its export stance. Probably that means more jet than it does diesel, just looking at which fuel dropped the lowest in terms of exports over last month. But it's, that generally helps the whole middle distillate market. That's definitely true. But I'm still surprised at actually how weak the East-West has become. And on the European side, I don't see, I mean, generally speaking, it's very difficult to understand what a shift in ice gas oil spreads from plus 100 to plus 36 means over 10 days, particularly when the whole market's selling off. But I don't get the impression that Europe is pricing extreme tightness, right, when everything is selling off. And the other thing about Europe is that seasonally demand is kind of weak. Runs apparently have been surprisingly to the upside. Europe has SPR release, and they're getting decent volumes from the US. All the US ARBs are open to Europe, despite all that, right? So you got even the New York Harbor ARB open to Europe. And I know that if you look at kind of tracking, Europe's diesel imports are low in April, but I just don't fully understand why the East-West is actually this weak. And I suspect it's too weak, and it's worth some risk being long East-West at this point in time. And I guess what also is counterintuitive is Asia still has big run cuts. I mean, I know that to a certain degree, South Korea, Japan have improved their crude availability. But there's also the whole rest of non-OECD Asia to consider. We're talking about 6 million barrels per day worth of refining, which is non-OECD Asia, ex-China, ex-India. They can cover half that with their own production. So we're talking Thailand, Vietnam, all that kind of stuff. But there must be some loss in their runs. I guess one kind of scenario might be that Asian demand loss is very great at this point in time. That might also be contributing to things. But I just think sequentially, let's say May, June, as we've been saying for a long time, I don't think it makes super sense that the East-West is this week. And a consequence has been that the Sika barrels now, for the first time since the crisis started, are pointing to Europe. So we're getting the Indian barrels now pointing west, when actually the West didn't have anything from India over the last month or two. It all went east. So I think naturally that is, in the past, one of the signals we would have picked up and said, hey, look, that's probably bullish for East-West then. So HOGO then on the back of that, as I said, I sound a bit like a broken record. Oh, the HOGO has to price up, the HOGO has to price up. And it does work to a certain degree. I mean, we had the HOGO starting this week at 2 cents per gallon. And now we're plus 13, last time I checked half an hour ago. That was into a nice gas oil sell-off, and it was into a TC14 sell-off. But all this actually kind of counterbalanced, and we still have the Houston diesel ARB very open to Rotterdam. We've got the New York Harbor ARB very open to Rotterdam. That's the reverse ARB, so to speak. And if you look at the shift in Pad 1 stocks last night, we had a big draw. We're about 2 or 3 of those draws away from very low Pad 1 levels, and you have an open New York ARB to Rotterdam. So it still looks to me like I would be bullish HOGO. I keep on saying it, but it looks like the US is going to run into trouble, particularly on diesel, in the next few weeks. And a portion of that is also the Gulf Coast USGC 10 diff. That is not as wide as it was, but it is still quite wide. And I still think that needs to narrow as well, because the US is just going to have to start to defend things a bit better. The one counter argument to that is we should get 1 million barrels per day more runs between now and sort of mid-June in the US. And runs are actually surprisingly low. If you look last night, the total US runs are the same as last year, at this time last year. So I'm expecting that changes a little bit. Maybe there's maintenance. I think Pad 4 runs are also particularly low. So it sounds like a broken record, but I think HOGO needs to price up.
I think we also had the Valero shutdown, right? We have less refining capacity in the US as well this year.
Yeah, generally speaking. But we have had big year-on-year gains over the last few months in runs, generally speaking. Like, they should be running extremely hard. And I think if you look at the quarterly earnings calls from the big refiners in the US, their plans are quite big in terms of utilization, understandably. And they also have lots of access to very tasty and cheap Venezuelan crude, very tasty and cheap Canadian crude. They're not short of cheap feedstock. And then the regrade is the last thing today, so they keep on dropping. Actually, if you look at the regrade now, there's probably a signal not to max jet yield. So what we're doing is we're running from one problem to another. We seem to have fixed the jet problem temporarily. And you can look at the US yields. They're up a lot, 2 percentage points. They're adding 1,200 KBD more to supply, going to Europe, some of which is going to Europe. Europe will probably be doing the same, and the regrades have all come off, and they're telling us not to max jet. In fact, we'll probably get a bit more diesel yield. And also gasoline is doing the same, right? If you look at the summer EBOB ULSD spreads, those are almost at ton parity again. So it looks like we've solved the regrade. I will be a broken record again, and I would say at these levels you should buy the regrade again, because we will start to unsolve the solution. That's basically what the regrade is telling us right now. All right, I've been droning on. June, do you want to talk about fuel oil and freight?
All right, I start with fuel oil. 0.5 crack has moved up since our bullish call last week. The June crack moved from $11 per barrel to now $15 per barrel. Dangote LSSR value as feeds into the West versus the better quality met straight run streams has narrowed to a more normalized level, suggesting a return to the usual for Dangote flows at these values, i.e. into VLSFO blending in Singapore. The VLSFO blend margins here has also flipped back to small positive at the back of firmer Sing low sulfur premiums. The supply is heard to be tight across Fujairah, Hong Kong and South Korea, pushing premiums higher in those ports. For June 0.5 East-West, it has risen to around $80 per ton, corrected to right around where the physical cost of moving a Suezmax from Rotterdam to Singapore currently stands, which is the value 0.5 East-West historically mean reverts to. We are not getting bearish from here, but the risk reward for an entry point at these levels look a lot less attractive than it was last week. Cash diffs for 380 CST and 180 CST high sulfur fuel oil are up by $15 per ton and $21 per ton week on week respectively. A quick fire round on freight. TD25 currently looks overvalued. WTI is no longer cheap into Northwest Europe as 40 divs have fallen off so low, and the relative Brent future sell-off. WTI EFRA up has almost closed. T22 looks okay. Rates have fallen to pre-war levels. Decent VLCC vessels availability in the US Gulf Coast, and the WTI up to Asia remains quite stable, which is very good. C14, however, is overvalued. MR ups on gasoline are very closed. Since RBOB, EBOB has rallied too much on low US stocks, TC14 already dropping off more than 100 world scales points since last week, and more declines are needed to keep the diesel ups that are open from Houston and New York Harbor to Rotterdam. Yeah, that's all for me. Anything to add, Neil?
No, that sounds very good. One interesting point on TD22 there, actually, the big sell-off yesterday, at least briefly, did see our landed values for Agbami and for 40s. They were landing within $1 to $2 per barrel of Murban. We have not seen that in a long, long time, and it's actually quite surprising. Again, we're wondering why more Brent crude hasn't been going to Asia. Up until now, we had 40s landing at $10, $15 per barrel premiums. Now with the Brent sell-off, that looks a bit different. So an interesting kind of thing might be approaching, particularly if the Murban volume is in doubt. So there we go. Let's see. All right, thanks very much, guys. A pleasure to have you on board again. Let's see whether we have peace or all-out war. Unfortunately, next week, we don't know. But just to caveat again, it's 10:41 on finishing recording. So by the time you listen, things may be different. And see you again next week.
Okay, thanks everyone. Bye.
Cheers.